If you currently share a checking or savings account with your husband, wife, child, or anyone else you care deeply about, please pause what you're doing and listen closely. What I am going to reveal over the next few minutes might rescue your household from a massive financial disaster, one that most folks are completely blind to until it finally strikes. There is a hidden danger lurking inside millions of shared bank accounts in America right now, and hardly anyone discusses it until the moment it causes chaos. By the time this video is over, you will know exactly what this silent threat is, why your bank probably won't warn you, and the exact steps you can take this week to secure the wealth you've spent a lifetime accumulating. Keep watching, because the most crucial piece of advice is saved for the very end, and you definitely need to hear it. Welcome back. This is the place for folks who want honest, clear information about their finances, their retirement, and how to guard their hard-earned assets. If you're new around here, please hit that subscribe button right now. We dive into essential, real-world financial issues just like this every single week, and I guarantee it will be worth your time. All right, let's dive in. Here's a fact that escapes most people. When you set up a joint account with someone else, you are doing much more than just putting their name on a bank form. You are granting them complete and total access to every single penny inside that account, effective the second the paperwork is signed. The bank does not care whose money it originally was. It doesn't matter who earned it, who deposited it, or who spent 4 decades working for it. As soon as that second person is attached to the account, they possess the exact same legal authority to spend, move, or withdraw the entire balance just as you do. For a lot of older adults, setting up a shared account just seems like the logical, simple choice. It makes paying bills easier, and it ensures someone can handle the finances if a parent falls ill. And to be fair, for many families it works out perfectly. But as we navigate 2026, banking regulations are shifting, scammers are getting much smarter, and family dynamics are more complex than ever. That innocent banking setup can morph into a serious headache, and it almost always happens in the background, out of sight, until the damage is irreversible. Let's look at the main reason people create these accounts. An aging parent realizes they might need a little help managing their daily finances or health expenses, so they add a grown son or daughter to the checking account. It feels like a smart, reasonable move. However, here's the crucial detail that is rarely explained at the teller window. There are actually different methods for adding a person to your bank account, and they have vastly different legal consequences, even if the forms look nearly identical. The first choice is generally known as a convenience account. This setup allows your trusted person to sign checks and handle bills for you, but they do not legally own the funds, and they have no right to keep the money after you pass away. The second choice is a standard joint account with rights of survivorship. In this scenario, that second person becomes an equal owner of the money right away, and when you pass away, whatever is left in that account goes straight to them automatically, completely ignoring whatever instructions you wrote in your estate plan. That specific detail is where the nightmare begins, and it's exactly why we need to talk about this today. Imagine a mother with 3 adult children. She has a will that clearly states her entire estate should be divided equally among all 3 kids. But a few years prior, she put her oldest son on her main bank account just to help write checks when her vision started getting blurry. That account included survivorship rights, though she was never properly warned about what that actually meant. When that mother eventually passes away, the money in that account, which might hold the vast majority of her life savings, does not go through the legal will process. It is handed directly and entirely to the oldest son. The will doesn't matter, and the equal split she intended goes out the window. The other 2 siblings might not receive a single dime, and by the time the family figures out the legal reality, there is absolutely nothing they can do to change it. This is not an isolated worst-case scenario. This exact drama happens in households all over the nation, year after year. It destroys families and causes permanent rifts, all over a banking error that could have been dodged with just one simple chat and the proper forms. Now we need to discuss account access, because this is where situations get tricky in a hurry. The moment someone is listed as a joint owner, they have the power to take out funds whenever they want, without requesting your permission and without notifying you later. Usually this isn't an issue. Families believe in each other. However, good faith and trust don't always shield you when life throws a curveball, especially if that family member faces severe financial struggles. Imagine you add your son to your account to help you out, but a year down the road he hits a tough spot. Maybe he loses his job, goes through a divorce, or faces massive medical debts. Here's a fact many folks simply do not realize. Debt collectors and creditors pursuing your son can legally seize the funds sitting inside your joint account. Why? Because the law sees him as a partial owner of those funds, even if you deposited every single cent. If he faces a lawsuit or a messy separation where assets are disputed, your life savings could get dragged right into his legal battles, despite you doing absolutely nothing wrong. Then there is a darker issue that nobody likes to consider, but we must face it head on because the statistics are simply too massive to sweep under the rug. According to studies by AARP, older Americans lose around $28 billion to financial abuse every single year. The most heartbreaking detail: the vast majority of those losses, roughly 70%, aren't caused by anonymous hackers or overseas scammers. They are carried out by someone the victim already knows and relies on, like a relative, a close friend, or a caregiver. The Consumer Financial Protection Bureau discovered that when a trusted insider is the one doing the taking, they actually drain far more money on average than a random con artist would. Unfortunately, a shared bank account can act as a wide open door for this exact type of abuse, because it doesn't trigger any security alerts. There are no weird overseas wire transfers to activate the bank's fraud detection algorithms. It is just a relative using a debit card, slowly siphoning away cash week after week. And since their name is legally printed on the paperwork, the bank has zero reason to stop them. The FBI recently noted that over 88,000 citizens above the age of 60 were targeted by financial fraud in a single year, with average losses topping $35,000 each. Keep in mind, those numbers only track reported crimes, completely missing the silent, gradual draining of accounts by family members that we are discussing today. Before we move any further, I want to make one thing perfectly clear. I am not telling you to suddenly distrust your kids, your spouse, or your loved ones. The vast majority of families create these shared accounts out of love, and most of the time, everything goes smoothly. The purpose of this video is to ensure you fully comprehend what you are agreeing to. That way, if a crisis ever does happen, whether it is a scam, a messy divorce, a lawsuit, or just a family disagreement about inheritances after you pass, you will have already set up safeguards. Taking preventative steps right now can spare your family from years of bitter legal battles, broken relationships, and lost savings. Let's look at another scenario that constantly catches families off guard. What exactly happens to the funds when one person on the joint account passes away? A large number of folks believe that when a spouse or parent dies, the bank will just keep things running as usual, or everything will seamlessly sort itself out. The reality is quite different. Banks have strict mandatory protocols. Depending on the exact way your account is coded, you could find yourself completely frozen out of your own money right when you need it most to pay for immediate funeral expenses or household bills. You might have to wait while the bank processes death certificates and proves ownership. Alternatively, if your account possesses the wrong kind of ownership title, it can completely override a well-crafted will, handing the money over to whoever happens to be listed on the bank file instead of following your actual wishes. Neither scenario is pleasant if you haven't planned for it, and they are surprisingly common simply because most folks never actually sit down with their banker and ask for a simple, plain English explanation of what will occur when an account holder dies. Here is another complication that grows more crucial as time goes on: planning for Medicaid and long-term care. If you or your partner ever require Medicaid to assist with nursing home expenses, the government scrutinizes your past financial records. They typically review the last 5 years to see if any assets were shifted around to artificially lower your net worth. Having a shared bank account makes this review process incredibly messy. The state might consider every single dollar in that joint account as belonging to both people, even if you were the only one depositing funds into it. Households that simply added a son or daughter to an account to make daily errands easier often stumble into severe Medicaid penalties, long delays, or total disqualifications right when they desperately need care. This is a classic example of an innocent, well-meaning choice causing massive financial distress years later, right at the worst possible time. So, what should you do instead? I am absolutely not suggesting you isolate yourself and handle all your money alone. For many older adults, having a reliable family member to lean on is essential, particularly when health or memory starts to slip. The secret is selecting the appropriate legal tool for your specific needs, rather than just saying yes to the standard joint account the bank teller suggests. For instance, setting up a durable power of attorney lets a dependable person oversee your money for you, without legally gifting them partial ownership of those funds. They get the authority to write checks, run your errands, and manage your bills, but the cash stays strictly yours. That means your savings are completely insulated from their personal debts or lawsuits, and when you pass on, the money is distributed exactly how your will dictates, rather than defaulting to whoever was listed on the bank form. Furthermore, plenty of financial institutions provide a payable on death option, often called a POD. This allows you to designate a specific person to inherit the funds the moment you pass away, entirely bypassing the lengthy probate process. The beauty of a POD is that the beneficiary has absolutely zero access or ownership rights while you are still breathing. This one simple setup completely eliminates the majority of the risks we've discussed. Your loved one receives the inheritance quickly and easily after you're gone, but they cannot spend it, mishandle it, or expose it to their own creditors during your lifetime. Banks are also heavily pushing trusted contact designations, and it's a feature you really need to understand as we move deeper into 2026. A trusted contact has zero access to your cash. They are simply an emergency contact that the bank has permission to phone if they spot strange withdrawals, potential scams, or signals that you might be experiencing cognitive issues or financial abuse. It is a completely free safety net that does not alter your account ownership whatsoever. It just provides the bank with an additional tool to stop fraud in its tracks before your savings are wiped out, because banks are under heavy scrutiny to protect their older clients. These trusted contact features are much stronger and more widely available than they used to be. You should absolutely ask your local branch if they can set this up for you. Now, I want you to ask yourself an honest question. Do you actually know, right this very second, what exact type of joint account you have? Many folks who opened these accounts decades ago have no clue if their setup includes rights of survivorship, if it's a pure convenience account, or what their specific bank will do the moment an account holder dies. That lack of clarity is exactly where disasters happen. Fixing this doesn't require expensive lawyers or endless paperwork. It just takes a single phone call or a quick trip to your local branch. Ask the banker to explain, in simple terms, exactly how your account is classified, what authority the cosigner holds, and what happens to the balance when one of you passes away. Ask for the answer in writing if possible. Then cross-check that information with your will. If your will says one thing but your bank account is programmed to do another, you have the power to fix it today. But that opportunity vanishes the moment tragedy strikes, and after that, the process cannot be reversed. I also need to highlight a factor that families constantly ignore: open communication. A huge percentage of these joint account nightmares don't stem from greed or malice. They happen because nobody was willing to talk about the details. Parents just assume the kids know the game plan. The kids assume the money will be split equally because that's what mom always talked about. Nobody actually verifies the bank documents until after the funeral, when grief is heavy and talking about inheritances becomes deeply uncomfortable. If you currently share an account, or if you are planning to add a family member to one, sit down and have a frank discussion about your intentions. Ensure everyone is on the same page about what the account is actually for. It might be slightly awkward for a few minutes today, but that is infinitely better than a massive legal fight or a shattered family relationship a few years down the line. There is one final, critical piece of advice you need to hear, and it is the step that almost every other guide on this subject completely skips. Honestly, it might be the most vital takeaway of this entire video. Even if you do everything perfectly, even if you select the correct account structure, establish a power of attorney, and have completely transparent discussions with your loved ones, there is still one single error that can silently destroy all those safeguards. And it has absolutely nothing to do with bank forms or legal documents. It comes down to how frequently you actually review your own transaction history. Financial institutions are legally obligated to watch for suspicious activity, but the boundary between a routine cash withdrawal and a malicious one is often totally invisible to a computer algorithm. If a relative is siphoning off minor amounts on a regular basis, it almost never sets off a fraud alarm because the activity just looks like normal, everyday spending to the bank. The only person equipped to spot that slow leak early on is you. By taking just a few minutes every month to review your bank statements, knowing generally what should be coming in and what should be going out, you can start asking questions the second a transaction looks unusual. This one simple habit, actually looking at your statements instead of just assuming everything is fine, is what separates catching a tiny problem early from waking up to discover tens of thousands of dollars have vanished. It doesn't cost a dime. It requires just a few minutes of your time, and it serves as the ultimate safety net for things that paperwork simply cannot prevent, Let me share one more real-world scenario that happens far more frequently than you might think, particularly with married couples who have shared their lives for decades. Imagine a husband and wife who have used the exact same joint checking account for 40 years. They trust each other implicitly, and money has never been a source of conflict. But as they age, one partner starts showing mild signs of cognitive decline, nothing severe, just forgetting small details here and there. Right around this time, they receive a phone call from a stranger pretending to be the bank's fraud security department. The caller urgently warns them that their account has been breached and insists that the funds must be moved immediately to a secure holding account to keep them safe. This is one of the most explosive scams hitting older Americans today, and it is incredibly effective because the caller doesn't sound threatening. They sound official, helpful, and highly urgent. The spouse, dealing with memory issues, desperately wanting to protect the household's savings, follows the scammer's instructions and wires a massive amount of cash before their partner even realizes a phone call took place. Because it is a shared account, the targeted spouse had total legal authority to move that money. The bank didn't block it or send a warning to the other partner because technically, an authorized owner initiated the transfer. This is the exact nightmare that trusted contact setups and routine statement checks are meant to intercept, but only if you take the time to put them in place beforehand. As we move through 2026, scammers are utilizing incredibly advanced technology, often cloning the voices of loved ones or manipulating caller ID to look exactly like your local bank branch. That makes it more critical than ever to hang up the phone and call your bank directly, using a verified phone number you look up yourself, rather than trusting the person on the other end of the line. It is also crucial to realize how your shared bank accounts fit into the bigger picture of your overall finances, because your wealth is rarely stored in just one place. Things like 401ks, IRAs, and life insurance policies do not flow through your joint bank accounts, and they don't even care what your will says. Those assets transfer directly to whoever is listed as the official beneficiary on the specific account form, regardless of any updated wills or who is named on your everyday checking account. This causes a bizarre and tragically common disaster. Someone updates their legal will after a nasty divorce, assuming everything is perfectly locked down, but they completely forget that their ex-spouse's name is still listed as the primary beneficiary on a retirement account they opened 20 years ago. When that person passes away, that retirement money goes directly to the ex-spouse. The updated will cannot stop it, and the family's true intentions mean nothing. Joint accounts and beneficiary forms completely bypass your will, which is why so many careful estate plans completely fail when it's time to execute them. The only guaranteed way to protect yourself is to gather every single statement you own, checking, savings, investments, and insurance, and verify exactly how they are titled and who is listed. Do not rely on your memory or outdated documents from a decade ago. Finally, I want to address a frustrating reality. Even banks with the best intentions can make this process incredibly confusing. The tellers working at your local branch are not estate lawyers. Most of them simply lack the specialized training to outline the deep legal impacts of different account structures. When an older customer walks in and asks to add a son or daughter to their checking account, the employee usually just clicks the standard default option. They don't take the time to suggest a power of attorney or a payable on death form, because processing a standard joint account is the fastest way to get you out of line. While it might not be malicious, it does mean the burden is entirely on your shoulders to ask the right questions. You cannot assume the bank is automatically guiding you toward the safest financial setup. Sitting down with a qualified estate planning attorney, even for just a single 1-hour meeting, can resolve issues that might otherwise cause years of family warfare and legal confusion down the line. Many of these professionals offer simple, flat-fee meetings designed specifically to look over your account titles and beneficiaries. Considering the massive amount of wealth sitting in these accounts as you approach retirement, that small upfront cost is an incredible bargain for absolute peace of mind. If any part of today's video made you rethink your own financial setup, or maybe the accounts your aging parents are using, or even an awkward chat you've been avoiding with your siblings, do me a huge favor and leave a comment down below. Let me know if you were already aware of how survivorship rights work, or if today was your first time hearing about it. I read every single comment, and your feedback directly helps me decide what crucial topics to tackle next. And if you got some value out of this, please share this video with a friend, a relative, or anyone you know who has a joint account they haven't reviewed lately. This is the exact type of information people tend to scroll right past, but it is life-changing for the one person who watches it before a crisis hits. rather than after. Safeguarding your life savings isn't about being paranoid or suspecting your family of theft. It is about building a solid foundation so that your trust and love never inadvertently turn into a massive financial liability. The folks who successfully dodge these disasters aren't the ones who stubbornly refuse to ask for help. They are the ones who took a few minutes to fully grasp what they were signing, demanded clear answers from their bankers, and verified that their documents perfectly matched their true intentions. By watching this far, you have already done more than most people ever will. Remember the core lessons from today: the vast difference between a simple convenience account and one with full survivorship rights, the risk of your money being drained by someone else's lawsuits, debts, or divorce, the heartbreaking reality of silent financial abuse inside families that cost billions every year, the Medicaid penalties that can blindside you, the danger of your bank accounts completely ignoring your legal will, and the incredibly simple, completely free habit of reviewing your own statements to catch what the system misses. You don't need to be suspicious of your loved ones to fix this. You just need to know exactly how your money is structured, ensuring that your family inherits exactly what you wanted them to have, rather than whatever a dusty, outdated bank form dictates. Before you click away, make sure to hit that subscribe button if you haven't already. Every single week, we unpack these practical, real-world financial realities that impact your retirement. We cover the vital details that standard financial advisors and banks fail to explain, and the tiny choices that make a monumental difference in your future. Leave a comment, share this video with someone you care about, and I will see you in the next one.